The depreciation of the US dollar is just the first step. The real killer move will be launched in 90 days. That means it's only 3 months left at most. This is the final time the US government has given us. If the Federal Reserve and the rest of the world still can't reach a compromise, then what comes next will be a financial crisis even more severe than 2008. This April's stock market crash already left countless investors in pain. But in less than 3 months, it might not just be a stock market crash, but a total global asset collapse. But at that time, it's also the moment when we cash out our safe haven assets and buy the dip. What does it mean? Hello everyone, I'm Money's In. Folks, you can forget your girlfriend's birthday. You can even forget your wedding anniversary with your wife. Because at worst, that'll just cost you a few Hermes bags, right? But there's one day coming up real soon. If you forget this one, your hard-earned wealth over all these years could be wiped out in an instant. And that date starts in February next year. Why? Because the US right now owes $38 trillion in debt. Next February will be the peak period for new long-term bond issuance in the new fiscal year. The US has to issue a massive amount of new long-term bonds just to pay off the old debt. So by mid-February, we'll know exactly how the US plans to fill that old debt. Wait, what does the US paying its debt have to do with us? Important days, huh? So even till now, countless people still don't realize how serious this is. Starting next year, the US is gonna borrow trillions more dollars again. Most of the old debt was borrowed during the pandemic. Back then, with the pandemic hitting hard, the economy was in the dumps. Even the US stock market hit circuit breaker a few times. So, the Federal Reserve at that time kept expanding its balance sheet, printing money non-stop. Then, they lent that freshly printed money to the US government and the capitalists at basically zero interest. That means the trillions of dollars in debt that the US has to pay back were borrowed at super low interest rates, almost zero. But here's the problem. Right now, the US government's treasury only has a few $100 billion left. They can't pay it back. So, they've got to borrow new debt to pay off the old debt. But in the past few years, the Fed hiked up interest rates. Even though they've cut rates recently, the interest the US government has to pay on new borrowing is still around 4%. What does that mean? Let's make it simple. 5 years ago, during the pandemic, I lent you $1 million. I promise you, as long as you pay me back the million when it's due, I won't charge you a single penny in interest. You were happy, right? Cause for those 5 years, it's like you basically gotta spend that million for free. No interest. But here's the problem. Now you've spent it all. You can't pay me back. So what do? You gotta go find someone else to borrow $1 million from to pay me back. Then you owe that new guy $1 million. That's borrowing new debt to pay old debt. But this time, the guy who lent you that $1 million charges you 4% interest every year. So, after 5 years, not only do you gotta pay back the $1 million, but also an extra 200 grand in interest. Get it? It's the same with US Treasuries. During the pandemic, the US borrowed low interest debt, basically near zero. So they spent freely. And now, the US Treasuries down to just a few $100 billion. And now, this bonds is coming due. The US has to pay back trillions, but they can't. So they've gotta keep borrowing from others. But here's the issue. The interest on the new bonds has jumped to about 4%. So, starting next year, the US goes from paying basically no interest to pay 4% high interest loans. It's like swapping out old low interest debt for new high interest debt. That's why the US government keeps pushing the Fed to cut rates. Their treasuries only got a few $100 billion left. That's not enough to spend. It'll run out in just a few months. At the same time, every year the US still has to pay back trillions in old debt. And if they can't pay it back, they'll have to borrow high interest loans, which is the 4% new debt. But the biggest problem? They might want to borrow, but no one is willing to lend. What do I mean? Why was the interest on US debt so low before, but tons of people still rush to lend their life savings to the US? Like, if you've got $1 million after 5 years, the US only pays you back $1.02 million in principal plus interest, totally loses to inflation. But you still rush to lend money to the US to buy US Treasuries. Why? Because the price of Treasuries goes up. Back then, if you lent the US a million, they'd give you $1 million IOU. That's the US Treasury bond. Then you take that bond to the market and sell it. And boom, you might flip it for 1.1 million right away. Because in the past, the price of US Treasuries kept rising. So people wanted to lend to the US early on. Because the earlier you lend, the lower the price you get that IOU at. And then when it rises more and more, you're gonna make more money through selling it. Basically, the US Treasuries IOU was something you could speculate on. You can see it right here on this chart. If you had lent money to the US back in 2014, which you buy in the US Treasuries, by March 2020, your Treasuries would have doubled in value. That's doubled in just 6 years. And with so many people scrambling to buy Treasuries, you didn't have to worry about not being able to sell them. Plus, the guy who owes you money is the United States of America, the global superpower. You're not afraid they won't pay you back. That's why US Treasuries have always been called risk-free assets. So think of it this way. In the past, if you bought Treasuries and the price dropped, you could just hold on and it'll bounce back up. And even if it didn't, you could just wait until maturity and get all your money back from the US government. Basically, buying Treasuries meant you pretty much couldn't lose money. And on top of that, they could double in 6 years. Because of this, tons of people started leveraging up to buy Treasuries. Let's say today I've only got $1 million. I bought $1 million in Treasuries. Then I take that $1 million in Treasuries to the bank and collateralize it to borrow 950 grand in cash. Then I use that 950 grand to buy another 950 grand in Treasuries. And then I take those 950 grand in Treasuries back to the bank, collateralize them for another 900 grand, and buy Treasuries again. Keep repeating this. Collateralize and buy cycle. Through this kind of leverage, I could go up to 56 times. In other words, they just need $1 million. They could buy 56 million worth of Treasuries. But now, look carefully at this chart again. Since March 2020, the price of Treasuries started falling non-stop. Now imagine you're the bank now. A client brings in 1 million worth of Treasuries as collateral, borrows 950 grand from you, but now the Treasuries price has fallen to 950 grand. If it keeps falling, could the client just decide not to pay you back? Because he borrowed the 950 grand from you, and if his collateral Treasuries fall to 900 grand, do you think he'd pay you back the 950 grand to redeem something now worth only 900? No, he wouldn't. So when the US Treasury prices start falling, you, as the lender, have to chase them for repayment. That means all these people who leveraged 56 times were getting hit with massive debt collection. So they have to keep selling Treasuries to pay back debt. Sell Treasuries, pay debt in just 3 years. All the gains that Treasuries made over 6 years completely wiped out. So why did Treasuries crash so badly? Because China and Japan have been dumping massive amounts of Treasuries these past few years. So here's the key point. Why did people rush to buy US Treasury bonds back in the day? It's exactly because they just kept going up. But the US Treasuries keep falling now. They've entered a bear market. Even countries like China and Japan are dumping massive amounts of Treasuries. A few years ago, tons of US banks failed because of holding huge losses on Treasuries. So now, would you still dare to buy US Treasuries? That's basically saying that the US is running out of money in its Treasury and now it needs to borrow high interest loans. But even with high interest loans, it might not find anyone willing to lend. So what's next? These US Treasuries are like an old rundown, crumbling house, ready to collapse any second. You can choose to keep repairing and fixing it, but no matter how much you fix it up, it's just look better temporarily. But still can't change that the foundation is old and broken. Still gonna collapse anytime, but that's okay though, because you still have a choice. Just blow the house up and rebuild a brand new one. In other words, if you are the US government, you can either trying to keep the US Treasuries alive or to find a way out of an impasse, blow the house up. Just blow up the US economy and drag the whole world down with it. Then rise from the ashes, make America the fastest recovering economy again. Rebuild the house. What would you choose? Back in 2008, the US chose to blow the house up. But now, tariffs are like the bomb that's going to blow up the entire global economy. If you've experienced the despair of the 2008 financial crisis or the panic of the stock market crash in 2020, you should know countless people who thought it was none of their business. Their wealth can disappear in an instant when the crash hits. But for those who had the script in advance, can plunder that wealth. If you don't want to be one of the victims in this game, and even take it further and climb to a higher class, then you should subscribe to my channel, because I'm gonna be giving you more information like this. And if you're worried you'll forget everything after hearing it, and you don't want to waste your time, you can like this video and it will be automatically saved in your playlist. So you can come back and follow it anytime. So what's the US government really need to do? To fix this swapping of low interest debt to high interest debt and the problem of running out of money, there's only one answer. Let the US deep pockets step up for the last resort. What I'm saying is, let the Fed fire up the printing press to print more money, and take that freshly printed money to buy US Treasuries. Lend the money to the US government to spend, and sure, lower the interest rate, better be zero, right? But here's the problem. Why would the Fed help the US government? Because if nobody takes over US Treasuries, the US can't pay its $38 trillion debt. So they have to default, which is admitted directly. Our IOUs are worthless paper. Everyone who lent money to America, you take the US Treasuries, IOUs, can't exchange them for US dollars anymore. The money you lent, the US is gone. And if a country as big as the US can just default on its debt, then the whole world will dump US dollars right away and exchange it to other assets. It's simple, like it's the same as bank. Why would I put my money in your bank before? Because I thought that give it to you is safer than keeping it at my house. But now, your bank is announcing default, and I might not get my money back. Don't I rush to your place and get my money out of it? And why do we use US dollars? Because I believe holding dollars is safer than holding my local currency. Take Ukraine, for example. Your country is at war, but as long as you are holding US dollars, you can still keep your wealth. The most important is that the US dollar is tied to US Treasuries. That means I need dollars to buy US Treasuries. Basically, I hold the dollars so that I can lend it to the US government. But now, the US government defaulted, refused to pay the money back. The value of the US Treasuries I hold become worthless. So do I still want to hold your dollars? Is it still safe for me to hold your dollars? The bank default will trigger the bank run. The US government default will trigger the dollar run. And the method of run is everyone sell dollars and swapping into other safe assets. So if the Fed doesn't save treasuries, the US government would default. Then dollars will face unprecedented dumping. The US dollars will become worthless paper. All the assets in the US will become worthless. So the Fed has no choice but to save it. Because if they don't, those capitalists behind the Fed, their money and assets will turn to dust and vanish. In other words, whether the Fed does QE and prints money to save treasuries, there's really nothing to think about. Unless the capitalists want to go down together with the US, and the Fed just announced it's stopping quantitative tightening in December, which is to stop taking the money back. The what's coming next is doing QE, basically print money, give out the money back. So saving treasuries is inevitable, but the Fed still gets to choose how to save it. The first method is that I can do QE and take over the US government's treasuries, right? But I don't have to cut rates. I can still remain the 4% high interest loans. A lot of people said 4% interest is not a high interest. Guys, the US government used to borrow money without interest. It's nearly zero, now it's 4%. Aren't the interest costs several times higher now? And when the US borrows, they borrow in trillions. Even in 1% interest, that's a huge cost. But when we borrow money, it's just a few tens of thousands. Even if the rate is 50%, the total interest isn't that big. So if the Fed doesn't cut rates, the US government is basically working forever for the capitalists behind the Fed, because all the money America makes will go toward paying interest. More simply, when Americans earn money, they've got to pay taxes to the US government. And the US government takes the money that the American earned to pay high interest loans to the Fed and other capitalists who hold the short-term treasury. If the Fed keeps the rates that high, then more and more businessmen in the US will collapse under the pressure, because now even the US government has to pay 4% interest to borrow money. Then for the businessman, the interest on the debt you borrowed from the bank would be even higher, right? And the interest is too high, you can't pay it back. Then you're going to go bankrupt, right? Once you go bankrupt, a lot of people will lose jobs, right? And if people lose jobs, they won't spend money and the economy will go into a recession, right? So can a recession straight up trigger a stock market crash? And at that point, people like Buffett, who've already dumped massive US stocks and are holding enormous cash reserves, can they just buy bottom fishing America's cheap sale assets? So during this period, Buffett's holding is not just cash, but also cash assets, which are short-term US Treasuries. Basically, 3 months to 1 year, the US government has to pay him back the principal plus high interest in full. In other words, Buffett can not only get to lend at high interest while riding on the back of the US government, but whenever he wants to buy the dip, he can turn his short-term treasuries into US dollars for bargain hunting. And this is what we mentioned at the beginning. There's an old, crumbling house. That is the US Treasuries. You can try to repair it or fix it. Basically, let the Fed step in for the last resort. But the house, US Treasury, is still old and crumbling. Still no one really wants to buy it. The interest rates are still dictated by the Fed. And it's still a tool capitalists use to grip America by the neck. So, Trump never demanded the Fed expand the balance sheet or print money. He only ever wanted one thing: cut rates right now. And yeah, the Fed has cut a bit. But on the path ahead, for more cuts, they're still super cautious. So to the US government, all he can do is to directly blow up the house. Let the US Treasuries crash, let the stock market crash, even the US dollar crashed along with them. Force the Fed not just to print money, but to print massive amounts. Print rapidly and cut the rates all the way down. Because when it's crashing, if the rescue is even a little bit slow or too weak, it won't work. And this powder keg is slapping tariffs on the whole world. So people who are a bit smarter should be able to see it. Whether the Fed chooses not to cut rates and keeps printing money slowly, or gets pressured by Trump to slash rates and print money fast, the final result will be the same. That is, the US assets must go through a plunge or even a total crash. But do you know that every market crash is a moment of wealth redistribution? In the 2008 financial crisis, some people went bankrupt and jumped off buildings, while others bought the dip and got filthy rich. 2020 pandemic crash. Retail investors wiped out. Hedge funds casually made 3 times profit. And this year's crisis, it'll be the last opportunity for regular people to change their fate. Why do so many lose money during a plunge? Because people with no stocks just blindly chase the dip, end up catching it halfway down the mountain. People who hold stocks either panic sell at the absolute bottom or stubbornly hold on waiting to break even and miss the profits from both the plunge and the skyrocket. So if you're still getting brainwashed by something like just hold long term, it'll come back, this kind of irresponsible advice, your wealth is going to get crushed by the times. So you've got to learn how to spot the signs of a market top before the plunge to lock in profits in advance and catch those explosive opportunities when the trend reverses. Here's the main point. The Fed is remaining a cautious attitude now. Doesn't mean it won't pump priming when the crash hits. If we just look at the result, isn't that exactly following the Harvard script? Step 1 is the US dollar devaluation. A house worth $100 billion. You think that's expensive or not? Most people would say yes, right? But what if I tell you now, $100 billion equal 1 NT dollar. Basically, you can use 1 NT dollar to buy that house valued $100 billion. You still think it's expensive? So with the US dollar depreciation, the house depreciates too. Same logic. The US dollar depreciates. Does the debt depreciate as well? America owes $38 trillion, right? Now, the US dollar index has already depreciated a lot this year. That basically means that the $38 trillion that the US owed will be less paying back. And that less paying part is the just result now. What if the US dollar keeps falling? Does the debt need to be paid less and less? That's the first step. Then, how do you make the US dollar fall? By triggering a stock market crash. The US dollar plunge this April is exactly because the US stock market plunged and the global capital fled from the US to other countries. So the whole world is dumping US dollars. Then the US dollar depreciates. And if the US wants to further lighten its debt load, wouldn't it to repeat the stock market crash once again next year? Or even twice? Then step 2, push up the gold price. Make whatever the US dollar or global currencies depreciate compared to the gold. Why? So in the first step, the US dollar fell, while your country's currency rose. That's right. But now, the US dollars and your country's currency are both falling against the gold, which means gold rising. So the rise of gold to the US is good or bad? A lot of people actually don't know. The US holds over 8,000 tons of gold. It's the country with the most gold in the world, more than number 2 to number 4 combined. And these 8,000 tons of gold is just the US own gold. Actually, a lot of countries store their gold in the US. Like Germany has about half of its gold held by the Fed. So in total, counting America's own gold, plus foreign reserves stored in the US, but they can't take away, it's around 15,000 tons of gold. And that's just the estimated number. At the beginning of this year, the US said it was going to put tariffs on gold. And right after that, countries around the world started rushing to move their gold from the UK to the US. So, if gold keeps going up in price, is that good or bad for the US? Well, the assets that the US hold rises, become more valuable. Sure, it's a good thing. So, the other countries don't want to buy US Treasuries, huh? That's fine. Just buy gold instead, because gold is also one of the America's assets. In other words, when it's in the step 1, the US needs to pay back its debts to the rest of the world. So the US dollar fell. That way, the US can pay less money. But the US not only has dollars, but we also have gold. So in step 2, our gold skyrocketing in value. That means on one hand, use the dollar's fall to pay the debt. On the other hand, use the gold's rise to hedge. One fall, one rise. Doesn't it just balance perfectly? Then the step 3, use tariffs to blow up assets and currencies worldwide. Then team up with the Fed doing quantitative easing to save the market and get the money back from gold into US assets. And if the tariffs restart again, then the whole world's assets and currencies could crash once more, right? Probably in the first half of next year. A global economic crisis may happen. Global assets will sell at a huge discount. As I said earlier, the Fed is remaining a cautious attitude towards cutting rates. Doesn't mean when the crash moment hit, it won't stop printing money. So if it copies 2008 or 2020, the Fed will not only do QE, but also lend money to the US capitalists at nearly zero cost to buy the dip on US stocks and the US assets. Then US stocks and assets are gonna skyrocketing again. The US economy will recover faster than the rest of the world. And by then, the world will furthermore dumping their own assets cheaply, cash out, exchange into US dollars to buy the US assets. That way, global assets and currencies will depreciate even more. At the same time, America can push gold prices down, drive money out of gold and back into dollars, US stocks, and treasuries. Then all US assets get a full phoenix rebirth, skyrocketing again. And step 4 is simple. US capitalists can cash out at the top, then take their rising dollars and bottom fish the world's discount assets. This is blowing up the house and rebuilding it. So you might think, this all sounds like a wild theory I just made up. That's fine. Let's look at the history. Economics tells us that when the US does QE, then the money supply increases, so the money should lose value, right? But let's look at what actually happened. Before the 2008 financial crisis, the US dollar plunged. Then, after the crisis, when the Fed printed an insane amount of money and cut rates, the US dollar actually went up. It appreciated instead. Then, let's look at the 2020 pandemic. Before the US stock market hit the circuit breaker, the US dollar plunged again. And after the market hit the circuit breaker, the Fed printed money with no limit, even slashed the rates to nearly zero. Then the US dollar went up. Why? Because in reality, before every US stock market crash or crisis, the US capitalists will sell off their US assets in advance and move their money to the other countries, blowing up bubbles in other countries' markets. So the US dollar will fall, while other currencies will rise. Till the US dollar and US assets become cheap enough, those US capitalists come back to buy the dip in the US. Then the Fed will save the market, lending money to them, with nearly zero interest, push up the US assets price again. And when the rest of the world is collapsing because of the financial crisis, but the US assets start rebounding, all the global capital will start moving into the US, buying massive amount of US dollar. Then the whole world's assets will sell at a bargain price. The US dollars will appreciate. In the end, capitalists can take those appreciated US dollars to bottom fish the world's even cheaper assets. So if the reality is happening now, looks like history more and more. If assets like gold and the Japanese yen, the traditional safe havens we've been positioning in since last year, keep rising while the US dollar keeps falling, then that proves at least one thing. Our first half strategy was right. Next comes the second half. We'll see next year how the US government plans to pay its huge debts and whether it will trigger another global asset crash. If it does, then we can follow the trend. We'll exchange our appreciated gold and Japanese yen back into depreciated US dollars and wait till the Fed starting QE, even flooding the market with nearly zero interest. Then the US dollar and assets could probably rise again, and I will find a perfect entering point to buy the US assets. And in the end, when they surge, we'll decide whether to cash out or position into depreciated assets elsewhere in the world. And even if there's no crisis happening, even if the opportunity doesn't come, I still lose nothing, right? We can just cash out and reposition again. So, if you don't want to miss the next opportunity to get in, what you need to do is to get ready in advance. Sync up our language first, because if you miss the bull market, who knows how many years you have to wait again. Alright, if there are any details in today's video that you didn't quite understand, feel free to leave a comment down below. And the situation lately is only going to get even more turbulent. Due to time constraints, I have to end here, but what about the next episode? What do you expect? A lot of people have been waiting all week just to hear that part. It's gonna be a crucial one. Alright, I'll continue sharing tips on how to become wealthy, how to be an entrepreneur, an investor, and achieving financial freedom every Wednesday at 8:30 p.m. If you don't want to miss out, make sure to subscribe my channel and click the little bell and generously share this video. I sincerely wish all of you who like this video will reach financial freedom soon. If you have any questions, please leave them in the comments. As long as you can find 1 or 2 useful sentences in today's content that can help you live a better life, I'll be completely satisfied. Alright, I'll see you next week. Bye!